If you've heard about using Indexed Universal Life or IUL as a way to supplement your retirement savings or 401k and you're curious to learn more, this masterclass is here to help. Spending the time to understand before jumping in can save you thousands of dollars because you will avoid poorly designed policies. IUL is a long-term commitment, so knowing what you're getting into is crucial. Now, while there are many IUL videos out there, they often skip important details, so I've included a lot of details here. I'm going to have timestamps for the various sections, so feel free to jump to any specific section you are interested in, but I will highly encourage you to watch the whole video in order to get a full picture. Hey, welcome back. My name is Gilbert with ZA Financial. Our mission is to promote transparency and education around life insurance and financial products in general. If you find this masterclass helpful, please don't forget to like the video and subscribe to our channel. Thank you. If you are new to the world of life insurance, there are two types based on the length of coverage. We have term life insurance and permanent life insurance. Term insurance provides just death benefit. There is no cash accumulation. Usually lasts between 10 to 30 years, and once the term is over, the contract ends unless you renew it. It is more affordable compared to permanent life insurance. Permanent life insurance, on the other hand, covers you your entire lifetime. It combines a death benefit with a cash value component that grows over time. It typically has higher premium than term insurance, but it covers you your entire lifetime and also accumulates cash over time. When it comes to permanent life insurance, there are various types, but in this video, we are going to focus on Indexed Universal Life, also known as IUL. I have a separate video on the different types of life insurance, and I'll put a link in the description below, so feel free to check it out. IUL provides death benefit protection, generally paid income tax-free to your beneficiaries, which can help cover various financial concerns such as income replacement, final expenses, mortgages and other debt, supplemental college funding, or other financial emergencies. In addition to the death benefit, IUL provides other advantages such as the potential to build up cash in the policy tax-free access to available cash value through policy loans and withdrawal, and access to death benefit in case of chronic or terminal illness, also called living benefit. There is no stock market risk in an IUL since the money is not invested in the stock market. Also, it is flexible in terms of premium payment, and there's nothing like a required minimum distribution or age or salary restrictions. The accumulation value potential is one of the main reasons to consider IUL, so it is important to understand how cash value works inside an IUL policy. The policy has a premium payment, which is money you send to the insurance company on a schedule you choose. It can be monthly, quarterly, semi-annually, or even annually. When the insurance company receives the payment, they deduct a premium charge and the rest of the money becomes part of your cash value. This happens at the time of contribution. Then on a monthly basis, the insurance company will deduct any cost associated with the policy for that month. The remaining cash above the cost of the policy is then allocated to either a fixed account or indexed account for potential accumulation. You can allocate all of the cash value to either account or mix and match it. For example, 40 to the fixed account and 60 to the index account. With a fixed account, also called the general account, the policy is credited annually at a predictable interest rate no matter what happens in the market during the year. So let's say you have $10,000 in your cash value and the fixed account interest rate is 5%. We know that at the end of the year, you will get $500 credit. Very straightforward and predictable. With an indexed account, it is credited based on the performance of one or more external market indices. An example of a market index is S&P 500, which represents 500 of the large companies in the US. I'm referring to companies like Apple, Microsoft, Amazon, Tesla, and so on. Two components that determine how interest is credited in an IUL is cap and participation rate. A cap is the maximum interest rate a policy can earn in a specific period, usually annually. Participation rate determines how much an index increase, will be used to calculate the indexed interest rate during the crediting period. Now, if this doesn't make sense, hold on, let's look at some examples and I believe you will understand it. In this hypothetical example, we are assuming the cap is 10%. In our first example, the index return is 8% at the end of year one. Because the index returns 8%, which is less than the cap of 10%, you will get the full 8% credit. In year two, the market crashes and has a return of negative 6%. Since IUL has no market risk, you will not lose anything but receive a 0 credit for the year. This is what we mean by downside protection. You don't lose anything, but rather you receive no credit from the index. In year three, the index return is 12%. Because the cap, which represents the maximum interest rate possible, is 10%, you will get 10% for anything above 10%. Once again, the cap represents the maximum interest that will be credited. So that is how a crediting method based on cap works. Let's do something similar, but this time for a crediting method which uses participation rate. In year one, the participation rate is 100%. This means you will get 100% of whatever the market returns. Since the market returned 8% at the end of year one, in this case, you will get 8% credit. In year two, the participation rate increased to 130% and the index returned negative 6%. Since IUL has no market risk, you will not lose anything but receive no credit for that year. Again, this is what we mean by downside protection. In year three, the participation rate reduced to 120%. This means you will get 120% of whatever the market returns. Since the index return is 10%, you will get 120% of 10% return from the market, which is 12%. The participation rate represents the percent of interest credited, or simply percent of interest you will participate in. I hope this makes sense. The cap and the participation rate can change from year to year, and it depends on the insurance company, market volatility, and interest rate. So you can see that when the market performs well, you get some of the upside gains, but when the market crashes, you don't lose anything as a result of what is happening in the market. Now, this might sound too good to be true. How in the world is it possible to be able to get some of the market gains while at the same time avoiding downside risk? If you have this question in your head right now, I have an answer for you. The quick answer is the insurance company buys options. Now, if you don't know what options are, let me explain. An option is a contract that gives buyers the right, but not the obligation, to buy or sell an underlying asset at an agreed upon price on or before a specific future date. The key thing to note here is that it gives you the right and not the obligation. So it allows you to buy or sell if you choose to. Imagine that you found your dream house at, let's say, $300,000. You really want to get this house, but you're a little bit concerned about news regarding housing market crash as well as changes in the interest rate environment. The last thing you would want is to buy a house and the market crashes. But also at the same time, you don't want to miss out on this opportunity. What if there is a way to peek into the future and help you make your decision? Obviously, this is not possible, but an option gives you something close but at a cost. So let's say that the seller of the house allows you to buy an option on that house for $5,000, and the option will give you a choice to buy the house 1 year from now at today's price of $300,000. The key word here is choice. It gives you the choice. So let's fast forward to a year from now and the property is worth $350,000. Because you paid for the option, the owner is legally obligated to sell you the house at the original price of $300,000, which means you will walk away into the house with an equity of $45,000. Now, let's say a year from now, the housing market crashed and the house is now worth $250,000. With the option, you have the choice not to buy the house for $300,000 when the current value is $250,000. In that scenario, you will only lose the option fee of $5,000 to the seller. So the insurance company buys options on the index. When the market is positive, the insurance company exercises those options and uses the gains to credit your cash value. If the index stays flat or is negative, the insurance company just walks away and doesn't exercise the options. This is why you can get some of the upside but never lose money when the market crashes. Now, if you are following closely, you might be thinking, well, if the market returns negative, you will still lose the option fee. So how is it that you don't lose money? The answer is simple. Remember, the insurance company has a fixed account, also called the general account, and an indexed account. Let's say you have a cash value of $10,000. If you allocate the full amount to the fixed account, which earns, let's say, a 5% rate of return, you know that at the end of the year, it will earn $500. So your cash value will now be $10,500 at the end of the year. Now, let's say you select the indexed option. Instead of giving you the $500, the insurance company will use about $500 to buy the option, so the original amount is not affected. If the market index is positive, the insurance company will credit your account based on the gains in the market. If the index return is negative or zero, you will have the original $10,000. I hope this makes sense. Put your questions down in the comments below if it's not clear, all right? So how do you access money from your policy? There are two options, through loans and withdrawals. So let's take a look at both. Remember, we have two types of account in an IUL. That is the fixed account and the indexed account. So that leads us to two types of loans. We have indexed loans, also known as participating loans, and fixed loans, also known as washed loans. Let's see how an indexed loan works. So we have the insurance company's account, your policy's cash value, and your bank account. Assuming you have $100,000 in cash value and you want to borrow $10,000, the insurance company will send $10,000 from their account and charge you, let's say, 5% in this example. So they use your policy as a collateral for the loan. Your full cash value of $100,000 remains untouched, allowing it to earn interest credit as if you never took any loan. This type of loan gives you an opportunity to have an arbitrage or spread. What do I mean? Assuming the index returns 8% at the end of the year, then you will get a 3% gain or spread. However, if the market were to crash or produce a zero return, you will not get any interest credit, but at the same time, you are going to be charged 5% for the loan. This is how index loans work. The interest rate for index loans can be fixed or variable depending on the company. Let's see how the fixed loan works, also known as the wash loan. Same scenario, you have $100,000 in cash value and you want to borrow $10,000 using a fixed loan. This time, there is an extra account, a fixed account which earns at a fixed interest rate, let's say 2% in this example. The insurance company will send you $10,000 from their money and charge you at a fixed rate of, let's say, 2% in this example. This time, they will move $10,000 from your cash value to the fixed account, which also earns at a fixed rate of 2%. Your indexed account will now have a balance of $90,000. Because you are being charged 2% on the $10,000 loan, and at the same time you are earning 2% on the $10,000 moved into the fixed account, they cancel each other out and hence zero cost, or it washes. The question then becomes, should I do index loans or wash loans? Wash loans make sense if you want to be very conservative because we know exactly what will happen. The opportunity to get an arbitrage is what attracts people to index loans. If the index performs, you can get enough credit to pay the cost of the loan and then some. Obviously, you cannot tell what will happen in the market at the time when you're getting the loan. Another way to access money from your policy is through withdrawal. With withdrawal, the money you request is taken directly from your cash value. So if you have a cash value of $100,000, after withdrawal, the cash value will be $90,000. So pretty straightforward. One thing you have to be aware of is that any money above the cost basis will be subject to income tax. So what is cost basis? Well, cost basis represents the total money or premium you have paid into the policy. For instance, let's say you've paid $20,000 in premium into the policy and the cash value has grown to $25,000. If you withdraw $22,000, $2,000 will be subject to income tax. Because of this pitfall, withdrawal is not often used. The other reason for not using this method is that anytime you put money into a policy, it incurs a premium charge. So if you plan on paying back the money, a loan may be a better option. At retirement, when you don't intend on paying back, withdrawal up to the cost basis and then switching to loans can be a great strategy. By now, you have a fair understanding of IUL, but the next part of the video is going to be more crucial. We are going to look at the practical side of things. We're going to look at policy design, which means how to make sure your IUL policy is set up properly with the lowest expenses as well as the lowest commissions, because an agent has control over how much commission he or she earns based on how your policy is set up. When setting up insurance designed for maximum cash, emphasis is on maximum cash, we minimize the death benefit, meaning you pay the lowest insurance cost, allowing the rest of the money to be available for growth. Imagine you want to put $1,000 into an insurance policy. You can go for maximum death benefit or maximum cash. When you go for maximum death benefit, this is term insurance. With term insurance, you get the most death benefit for the premium you pay, but it doesn't build cash. The other option is cash value life insurance or permanent life insurance. With cash value life insurance, a portion of your premium pays the insurance cost and the rest of the money grows in the policy. In the 1980s, many wealthy people put a vast amount of money into cash value life insurance and enjoy the growth tax-free through loans. As a result, the IRS decided that when you cross a certain limit, known as the MEC limit, the policy will no longer be regarded as a life insurance contract, but rather a MEC, modified endowment contract. A MEC loses some of the tax-free benefits of a life insurance contract because it is treated as an investment. When you take a traditional life insurance, what do I mean by traditional life insurance? Traditionally, people bought life insurance only for the death benefit. Such designs will lean heavily towards the left-hand side of this chart because it has a relatively high base death benefit. If your goal is to maximize cash in the policy, this design doesn't work. As an agent, my job is to push the product from the left-hand side to the right as close as possible to the MEC limit, but not cross it. The sad thing is that not all agents know how to do this. Others also choose not to do it because it reduces their commission. The death benefit in an IUL can have two components. One is the base face amount, or simply the base. The second is the blended term insurance. It can be called supplemental term insurance, additional protection benefit. The name doesn't really matter. Basically, it's blended term insurance. The base is always required, but the blended term insurance is optional. So when I tell you your policy has a death benefit of $1 million, we can have several combinations. It can be 1 million base with no term insurance, or 500,000 base with 500,000 blended term insurance, or even 100,000 base with 900,000 blended term insurance. I want to point out that different companies will allow different blend ratio. So while some will allow as much as 1:10, which means you can have 10 times the amount of the term insurance as the amount of the base insurance you have, others will only allow 1:3. Now you might be wondering why I'm explaining what constitutes the death benefit, and the reason is this: very important. An insurance agent is compensated based on the base amount only. There's no commission for the blended term insurance. I'll repeat this again. An insurance agent is compensated based on the amount of the death benefit that is allocated to the base. The higher the base insurance, the higher the commission, and also the higher the expenses in the policy. So depending on how the insurance agent allocates the death benefit, the expenses and the commissions can be high or low. In order to help you understand how important policy design is, let's look at this case study. This case study has 3 scenarios. In the first scenario, we're going to use a level death benefit option. In the second scenario, we are using increasing death benefit option. And in the last scenario, we're still using increasing death benefit option, but we are blending term insurance as well. So we're going to see how each of these affects the design of the policy. Let us take a look at the first design. This is the first case design. We can see that the premium is $20,000 and the initial death benefit is $1,055,000. The death benefit option here is A, or level death benefit option. The base death benefit is $1,055,000 and there is no blended term insurance, hence the 0. So the sum of the base and the term insurance will give us the total death benefit amount right here. Let us look at the guaranteed scenario. The guaranteed scenario represents the worst possible case ever. It's assuming that the index credit is 0 every single year, and it is also assuming that the insurance company is charging the maximum possible expenses. How realistic is this scenario? I don't think it's really realistic. I don't see the markets returning 0 every single year. Insurance company is still required to let us know the risk in this policy. That's why they include a guarantee scenario in your illustration. It's something that you have to be aware of and decide whether this risk is something that you can bear or not. Obviously, if it is still risky for you, then a whole life insurance probably will be a better product since it has better guarantees than IUL. So for the rest of the scenarios, I am not going to look at the guarantee scenario since I don't think it's going to play out, but it is something that you should be aware of. With that out of the way, let's jump to the non-guaranteed scenarios. We have the non-guaranteed scenario, and you can see that we have alternate scenario and current scenario. Even though our focus is going to be on the current scenario, I just want to pass a comment about the alternate scenario. In this case, it is using the fixed interest account in which this product is 5%. So it is using 5% to do the illustrations for the alternate scenario. In the current scenario, I am using 6% to do this illustration. So this is a little bit conservative over this, but whatever we're going to talk about here applies to this as well. Now, the first thing that comes to my eyes right here is that I see that the cash value is 0 in year 1 and year 2. Now think about it. You are putting $20,000 a year into the policy and putting $40,000 into the product. I'm seeing $0 in here. This is not a good design, obviously, because think about it. Should something happen and you need money, you are not able to access any money since the cash value is 0. And for whatever reason, if you should decide that, look, I'm done with this product, I don't really want it, and you surrender this policy, guess what? There's no money. You are not going to get any money, and you're going to lose the $40,000 that you put into this product. Whenever you see zeros upfront in an illustration, that tells me something is not right with the design right away. Accumulation value and the cash value are a little different here. So you see that there's a difference between these two numbers. And this difference is the surrender charge. Looking at year 1, we can see a difference of about $14,000. So I can say the surrender charge in the first year is about $14,000. If you go to the second year, it even gets bigger to $29,000. Even though we are still seeing some money in the cash value the third year, the difference between these columns still increases to about $39,000 here. Think about it. In the third year, the surrender charge is about $39,000. So we've put $60,000 in this policy by year 3, and we only have $6,000. Very bad liquidity upfront, and should something happen to you and you need the money, and maybe you've heard that, oh, IUL gives you liquidity, you can access money when you need it. Guess what? You will be disappointed. This is why some insurance products have a bad name. It's because of their design. It's not necessarily about life insurance per se, but it's about how the agent designed the policy. We can see that this is a level death benefit option. So you can see the death benefit here is leveled up until a point where the cash grows so much that the death benefit has to increase to prevent the policy from being a mess. From this point forward, as the cash value increases, it's going to increase as well. One thing I want to point out is that you can see that at a certain point, the accumulation value and the cash value becomes the same. As at this point, there is no longer a surrender charge. For this Allianz product, there is 12 years of surrender charge. After year 12, these two numbers are going to be the same from this point forward. Whatever product you're looking at, whatever illustration you're looking at, you should be able to tell how many years of surrender charge we have looking at these two columns. I hope that makes sense. So when we come down to about 30 years down the road, we can see that we have 1.3 million here. And I mean, if you look at it, you say it's okay. I mean, an agent can sell you this policy. They'll tell you, hey, you put in $500,000 here, you have $1.3 million. So it's a good design. Are you ready to do it today or tomorrow, right? But this is not a good design because one, it lacks liquidity upfront, and also when we compare it to the other ones which we are going to look at, you can see that it's not really the best design. That is what we can see from here. The question is, how much commission do you think it's being paid for this design? The answer is $22,000. The T here represents the target premium. Some illustrations are going to say target premium, and other illustration will write TP. It's something that you should be able to find. Either it's TP or target premium, and usually it's at the bottom corner here. So if you're trying to find out how much commission the design that you have is going to pay out, that's where it is. Here we have the second design. Again, we're putting $20,000 into this policy. The initial death benefit has been reduced from $1 million from the other one to $340,000. The main thing I want you to pay attention here is the death benefit option is now B, or increasing death benefit. Again, there's no blended term insurance in this product. So when we add the 0 and the 340 base death benefit, we're going to get this $340,000. Let's look at the non-guaranteed numbers in this scenario. So here we have the non-guaranteed scenario, and we're still contributing the same amount of money, $20,000. This time we have some cash value. In fact, we have $4,000 here, and the accumulation value is a little higher as well. Changing the design has improved our liquidity a little bit more than the first one. The difference between the cash value and the accumulation value is about $13,000, which is better than the first design. Year 13, these two numbers become the same, which means the surrender charge is over. Surrender charge in this case is far better than the first design. Now, one thing that I really want to mention here is that a lot of people usually, when they have the increasing death benefit, they are like, well, do I get the cash value as well as the death benefit when I pass away? And the answer is no. The death benefit in an increasing death benefit option already includes the cash value. So check out this. You started with $340,000, okay? When we add this to the accumulation value, $17,668, you are going to get the death benefit of $357,668. So you can see that the cash value is already added to give you the death benefit. The death benefit is not set to 340 like it was in the level death benefit. Anytime we add this to our initial death benefit, we are going to get this number. So that's one of the things you hear Dave Ramsey say, oh, they keep the cash value. No, that's not true. The cash value is already included in the death benefit. And as long as the cash value increases, the death benefit is also going to increase. All right, so now let's go down to year 25. This is when we stop making the payments. The moment we stop making payment, we switch the death benefit from B back to A, or level. And the reason is we want to reduce the death benefit so that the cost in the product is very small. Now, because there's a ton of cash in this design, it drops just a little bit. So we can see that we went from $1.48 million to $1.463 million. And then from that point, as the accumulation value increases, or as the cash value increases, it will also keep increasing. 30 years down the road, and we're seeing that the cash value is now $1.58 million and the death benefit about $1.8 million. This design is far better than the first one. Liquidity was better and long-term cash was also better. What commission do you think an agent is going to get for this design? When we look at this T, or the target premium, is $7,000. So for this design, an agent will be paid $7,000. So far, it looks like it's getting better. I can't wait to show you what we have in the third design. This is the third design. We're putting in $20,000 in this policy. The initial death benefit is also $340,000 like the second design. The death benefit option is B, or increasing, just like the second design. The only difference is that instead of putting the full $340,000 to the base death benefit, we are only putting $100,000 to the base and then the $240,000 as blended term insurance. So the base plus the blended term insurance will give us the total of $340,000 in death benefit. I hope that makes sense. Let's see how the numbers change as far as the non-guaranteed is concerned. The cash value is now $14,000 in year one. So we're putting $20,000 in, and we're almost $15,000 here. Accumulation value has also increased a little bit to $18,000 here. The difference between the accumulation value and the cash value, which represents the surrender charge, has also reduced drastically to just about $4,000. So you can see that as we are improving this design, a lot of things change, especially liquidity upfront. If you have an illustration with very low numbers upfront, it is a design problem. We can see that the difference between these two keeps reducing until year 13, where they become the same. From this point forward, the two columns become the same as well. Again, I want to mention the death benefit is already including the cash value, because if we add the initial death benefit of $340,000 plus the accumulation value, it was going to give us the total death benefit we have here, and it's going to keep increasing every single year. At year 25, when we stop funding this policy, we are going to switch the death benefit from B back to A, and this is just to reduce the cost of insurance in the product. If we look 30 years down the road, which is quite a long time to investigate this product, we are seeing that we have $1.6 million in this product and a death benefit of $1.9 million, which is a little better than the second design, but far better than the first design. So policy design makes a huge difference in terms of liquidity and in terms of long-term performance as well. How much commission would an agent receive for this design? Well, let's take a look. Commission is now just $2,000. So think about it. Isn't it crazy? We've gone from $22,000 in commission all the way down to just $2,000. So who sets up your policy really matters. And you want to make sure you are not dealing with people who do not understand how to set these things up properly. Now that we've seen the growth in these policies, I want us to look at the expenses. Why? Why is it that these products, even though we're putting the same money in, are yielding different results? So let's check out the expenses for the various designs, and I'm sure you're going to really enjoy it. So right here, we can see the policy charges for the very first design. We can tell by looking at the higher death benefit. We have a number of columns. I want to go over each of them so that you fully understand what we are looking at. The first column is the premium charge. The premium charge is a percent of any premium you put into your policy, and the insurance company pays part of this to the state in which they are operating in, or the state in which the policy is written. You can think of the premium charge as sort of a load fee in a mutual fund. And then the next is the policy fee. The policy fee represents a cost in relation to documentation, the insurance company needing to mail you out, or let's say you take a loan and there's some paperwork and stuff like that. It has to do with paperwork. The next is the per unit charge. It represents the commission being recouped, and also part of that expense goes towards putting the policy in force, so underwriting and issuing of the policy. A bulk of it though is towards the recouping of the commission. In this product, for instance, you can see that the insurance company will recoup those costs over 15 years. After that, there's no more cost under the per unit charge. The cost of insurance in this case represents the base insurance. Now, this design allocated everything towards the base. So the $1 million and $55 is accounting for this cost here. The rider charges represent other additionals that you can be added on. Like for instance, if you have waiver of premium, or if you have a blended term insurance, if any of that is used, those charges will come under the rider charges column. The asset charge represents charges related to using bonus index. Since this illustration did not use any bonus index, we are not seeing any charges here. So when we add all these costs, we are going to get the last column, which is the total policy charges here. One thing to be aware is that the premium charge switches from 8% to 4% after year 9. Hence this change that we see right here. So if we go down to somewhere around year 30 or at age 70, we see that the cost of insurance starts to go out a little bit more. And then it starts going pretty high after somewhere around 80. That is how the cost in an IUL plays out. As far as the policy is designed properly and you have liquidity upfront, you are able to grow the cash to be able to take care of some of these higher expenses down the road. Now let's go to the second design and look at the expenses in those policies as well. Here's the expenses in the second design. We can see the premium charge and the policy fee are the same. The per unit charge has reduced drastically from over $3,000 to just $1,200. And the reason being that we switch from level death benefit to increasing death benefit, which reduces the commission drastically. Remember, from $22,000 to $7,000. And so that leads to a drop in the per unit charge. The cost of insurance has also reduced because we reduced the death benefit from $1 million to $340,000. There's no rider charges, there's no asset charges in this case. The last column, which is the sum of all this column, we have just over $3,000, which is far lower than the first design. If we scroll down a little bit and we look at the numbers down the road, we can see that the cost of the insurance starts picking up a little bit, and it goes up a little bit more after year 70. But once these policies are designed properly, you have liquidity upfront, they have several years to compound, and so even though the cost goes up, it is not going to be so significant to cause your policy to lapse or anything like that. All right, now let's jump to the expenses in the third design. Premium charge and policy fee are the same across all three designs. Per unit charge this time has further reduced drastically to just $454. Think about it. It was over $3,000 in the first design and $1,200 in the second design. And this is because of commissions. So how your IUL is set up determines how much cost you have in this product. The cost of insurance here represents the 100,000 base that we had. And the rider charges now has numbers which represents the supplemental term insurance, the blended term insurance that we added to this design. Adding all this column gives us the total policy charges here. So pretty straightforward. If we go down to age 70 or year 30 in the policy, we do see that the cost of insurance here, which represents the base insurance, is still quite manageable. The blended term insurance gets a little bit more expensive, but think about it, you save so much cash upfront, and so you have 30 years or so to compound this money, and the growth in the policy will be able to take care of all these costs without causing the policy to lapse. This is how the expenses and IUL plays out. Some illustrations allow the agents to be able to take the expenses out of the illustration. I do not agree with it. So make sure your illustration has the expenses. You want to see the expenses. You want to understand the expenses before getting any product. Now, an illustration represents one scenario. It does not mean that your policy is going to play out as you have it here, right? All the numbers will change and it's never going to be exactly the same because people may not find it according to how it was designed. Caps rate, participation rates are going to change. So think of the illustration as one possible scenario, and each year as the policy goes on, you get with your agent and you'll be able to know how the policy is going, and then you can manage it as you are going along the way. That's how I think about illustration. Nothing being shown here is set in stone. To get a properly designed IUL policy for maximum cash, we want to see increasing death benefit, properly blended term insurance, some cash showing in the first year. Whenever you see zero in the first 2 to 3 years, that is a big red flag. In fact, we want to see significant cash in the first year, like I've shown you in these examples. And if your agent is telling you that is how it always is, the first few years will have zeros, that is not true. That is a number one sign of a poorly designed policy. So seek another person's opinion. We also want to make sure that the ratio of the target premium, which is the commission, compared to the annual premium is as low as possible. We also want to make sure that the surrender charge is low. As you can see, this one we have less than $4,000 as surrender charge compared to $39,000 and $13,000 in surrender charge in the other two designs. So keep your eye open, seek for help, seek another agent's opinion on the design if you are not sure about it. And I believe it will save you thousands of dollars if you get this thing right. We cannot end this video without talking about IUL cons. Every financial product has a strength and weakness, so let's take a look at them. Number one, the cap rates and participation rates can change. This is why working with companies with good caps history is really important. Number two, the unit cost of insurance increases over time because IUL is built on annual renewable term. It starts off relatively cheap and over time the cost increases gradually. Number three, growth is not guaranteed. There will be years with zero credits as well as years with higher credit, but you just don't know how things will play out. Also, unless you have uncapped index, growth potential can't be capped. Number four, poorly designed policies will add unnecessary costs and commissions, affecting the performance of the policy. So work with people who are transparent about these things. Never buy any policy under pressure. Number five, you have to qualify medically. Therefore, it's better to plan whether life insurance makes sense in your overall financial strategy and get it as soon as possible if it makes sense. The last thing you would want is you need life insurance, but because of some conditions, you are not able to qualify. Number six, tax consequences if MEC limit is exceeded. The truth is that a lot of great companies out there will not allow this to happen. They will not accept any money that will cause your policy to MEC. A properly designed IUL policy can supplement your retirement account like 401k. It gives you flexibility in how to access money during bad markets without forcing you to sell your stocks at unfavorable prices. At the end of the day, IUL is somewhere in the middle. It is not too aggressive like the stock market, and neither is it too conservative like your savings account or checking account. Coupled with the tax advantages and death benefit, it can be a great tool if it meets your needs. If you've stayed with me all the way to this point, you are definitely in the position to make sure your policy is set up properly. Policy design matters when it comes to any form of permanent life insurance. Now you understand a little bit more about how expenses of these policies relate to the cash value and know how a properly designed IUL policy looks. I hope this video was helpful. If you have any questions about IUL life insurance in general, feel free to leave them in the comment section below. I always want my videos to be relevant to your needs. Don't forget to like this video so YouTube recommends it to more people. Also subscribe for future videos. If you need any help with setting up a properly designed policy or reviewing a policy you have, feel free to reach out to me. My contact is going to be in the description below. Thank you so much for your time, and I will see you in the next video. Thank you. Bye.